Andrew, there's been a lot of speculation about the Federal Reserve's next move heading into the end of 2025. What are your thoughts about what the Fed's going to do, not just this year, but next year?
I think the Fed's ultimately going to focus on the labor market going into 2026, and we think the labor market's slowing a little more aggressively than the market's pricing in. So we think the Fed ultimately cuts in December and then cuts more aggressively in 2026 than the market's pricing in, which is why we think there's kind of more value in bonds heading into 2026 than people realize today when you look at what the market's outlook is.
And 2025 was actually a pretty good year for fixed income. Where are you going to find opportunities in 2026?
Yeah, so 2025, as you mentioned in fixed income, you had basically bonds returning a little bit of coupon plus, and that coupon plus came from the fact that you had treasuries rallying on the front to belly of the curve. We think 2026, you're going to kind of see a similar result where spreads didn't change much in 2025. We don't think they actually go much tighter in 2026 either, but we think base treasury yields can go lower from here. And I think it's a good environment for active managers because you can look across the curve, you can look across different sectors, and there's still plenty of value when you look at how high not just base yields are, but how high yields are. That's a great environment for fixed income.
All right. Now, you recently launched the Eaton Vance Income Opportunities ETF. The ticker is XAGG. Tell me more about this strategy. Why do I want to own it right now?
So XAGG, or XAG as we like to call it, is going beyond your traditional ag. And we find that investors typically have too much exposure in your kind of core fixed income. So core fixed income being treasuries and IG corporates. XAG, as that name would imply, is going beyond your ag and looking in those plus sectors. So we're talking securitized products, emerging markets, high yield, floating rate loans. And these are sectors that offer a lot more yield, they offer a lot more spread, and they also offer some kind of diversification and uncorrelated ways if you combine these sectors together. So investors can kind of pick up higher returns and higher yields over time if you do so in a prudent way.
And how much risk is involved in these plus sectors, if you will? Sounds a little bit scary.
Yeah, no, obviously, if you did it in a way that wasn't prudent, it could be scary. The one kind of base of our fund is that it has to be weighted average investment grade. So there's this guardrail there that keeps us not in some unconstrained fashion. And so we have a little bit of a barbelled approach. We like certain parts of the agency mortgage-backed security market, but then we also find opportunities in emerging markets and high yield that when you combine those all together, it's giving you a standard deviation that's actually quite comparable to the ag, but giving you a lot more yield and spread in the process.
And then finally, if there's going to be something that throws off your outlook in 2026, what would it be? What's the unexpected thing that may cause you to reassess your outlook?
Yeah, so I mentioned at the top of the segment that I thought that the Fed would ultimately cut more aggressively than the market's pricing in because we felt that the labor market's going to deteriorate a little more than people believe at this time. If you were to see a reacceleration in the labor market and the economy kind of grow a little bit more fast than we were initially expecting, you could see the Fed not just stop cutting, but if they went the other way, I think that'd be a big problem, not just for spread markets, but just risk assets in general. We think that's a very low probability. We're going to have a new Fed chair that's coming in that's going to err on the side of more likely to be more dovish than Jerome Powell. And so we think it's a low probability, but certainly something to watch out for as we go into 2026.
All right. Well, thanks a lot for coming on and talking about it.
Thanks for having me.